months, we've seen market leadership shift away from what we call the Magnificent Six, a subset of the Magnificent Seven that meet our definition of high-quality stocks: Apple, Amazon, Alphabet, Meta, Microsoft, and Nvidia. And since the end of 2022, this group have contributed to roughly a third of market cap gains in the MSCI world, and outperformance has been pretty consistent. It's only natural after a period of weakness that the market would question whether this outperformance is sustainable. And typically, the pushback is on valuation grounds. But does the data really support this? On average, over 80% of share price returns for the Magnificent Six since the end of 2022 have been driven by earnings growth, rather than rising valuations. This is compared to that of the broader market, where expansion in valuation multiples has accounted for nearly 60% of returns. And historically, these stocks are actually no more expensive as a group than their long-term relative valuation average. And they're at a lower premium to the market than at almost any point over the past 10 years. Our analysis suggests that these stocks actually have a relatively similar revenue growth outlook to what we've seen historically. But they have seen significant improvements in margins and returns on capital. So, the Magnificent Six are similarly priced to before, but of far higher quality, in our view. There are clear and obvious issues with analysing group statistics and assuming that this is true for each individual stock. But to call the Magnificent Six overvalued, the story is more nuanced than headlines may suggest. You can read more about our analysis in the link below.